And Jason, as refreshing as it might be to talk about something other than the Fed and rates driving sentiment, that is pretty much the biggest game in town, isn't it? What else might drive markets?
Sure. So obviously everybody is out there white knuckling their way to some kind of investment outcome, and in 20 hours or so we're going to get the Fed pronouncements. I think investors need to focus on the Fed not so much as a primary actor here, but actually as a group that is reacting. And what are they reacting to? They're reacting to the economic conditions that we see. And for investors, partly the Fed reaction function is earnings. We saw good earnings out of Microsoft, an interesting company, one that I think has an excellent future. Now, is valuation good or not is a good question for investors. But ultimately, we thought we'd see 2021 volatility. We didn't, because earnings grew into some of the valuations in the market. The bar is high in 2022, but the Fed is reacting, not acting.
Well, the markets are also reacting to the Fed, though. We've seen some wild gyrations. How accurately do you feel the market's pricing in likely Fed moves?
I think at this point, the market is pricing in a wide variety of potential Fed actions. In other words, we're seeing increased volatility as potential outcomes widen. That's a good thing. In fact, that's exactly what the Fed needs to do. What the Fed had done is lock themselves into a particular pathway, one that turned out to be incredibly inappropriate for what evolved economically, not just in the US, but globally. Now they're opening up the possibility. When are they going to finish tapering? How many hikes? How quickly? Those are reasonable and important questions in an environment of high volatility, which is itself causing or engendering market volatility.
Yeah, that volatility, as this GTV chart on the Bloomberg shows, is showing that the S&P 500's trading range is really far above the norm that we've seen in the last few years or so. Jason, so do you buy into this volatility? Do you buy the dip? And if so, how do you try to gauge what the bottom looks like?
For us, the bottom isn't just the entire market. It's individual names and opportunities. So what I see is a market that's shifting its focus from hopes and dreams to cash right now. And that happens, that sentiment change is very relevant. And the good thing for investors is companies that are providing cash right now are actually not tremendously highly valued, certainly relative to the market. So global dividend payers are really excellent places, not just to ride out higher rates, but to actually enjoy a good income outcome for investors.
And does that include global markets, also emerging markets? Because we have seen a lot of flows going into developing nations with the idea that perhaps those central banks really preempted the Fed's moves and they're doing a better job in taming prices.
It's definitely the case that certain emerging markets, again, emerging markets is incredibly complex and varied, but certain emerging markets have gotten ahead of the Fed and somewhat blunted the reality that the Fed's policy is also global policy. You've seen in past market episodes, Fed rate rises really hurt emerging markets. Well, now valuations in a number of different emerging markets are much, much, much lower than in developed markets and present some opportunity, absolutely.